All right, so now 10.20 is the identification of audit sections. Now the purpose behind this document is for you as the auditor to go and make a decision, what components am I actually going to audit at the end of the day? Which of these are going to be part of my audit file? In other words, which items are going to be allocated to my cycles? Now within RAC we're up to 27 different audit programs that we made provision for within the working papers. But let's say you take a RAC small and you've only got a balance sheet and an income statement. Then there's this huge overhead in terms of excess documents that you need to go through and mark as not applicable, which you don't even need. So at the moment, if I open up my audit programs, I don't have audit programs in place except for my journal cycle. That's the only audit program that I sit with at the moment. Okay, so the purpose behind 10.20 is to enable you to go and choose these items, design your cycles, and basically be able to progress with the audit and decide what audit programs you're actually going to have at the end of the day. Now, what the standards tell us is that we need to get sufficient and appropriate audit evidence over all material balances. So the very first thing, and the reason why we've already calculated materiality before this point, is we needed to know what balances are actually material. Okay, so in the first column, after the balances are portrayed, we have a quantitatively material calculation, and this automatically will tell you yes or no whether this is an applicable component. Well, in fact, it'll tell you whether it is more than materiality. Okay, so the first item absolutely is material. There's 139 million cost of sales. That's definitely material. I think if you recall, our performance materiality was 4.5 million from our session last week. Payroll expenses, definitely material. Then we get to depreciation. Depreciation is 581,000, and it's telling me that it's not quantitatively material. Okay, but where there is a balance and it is not quantitatively material, in other words, it's not more than 4.5 million, it does highlight the cell for me to give an indication of whether this is maybe qualitatively material, even if it's not quantitatively material. Now let's just go and consider something like this line item, depreciation, 581,000, it's not material, but are you really going to be able to audit your PPE effectively if you don't have depreciation being audited? At the end of the day with PPE, you're going to audit it anyway. So I would go and say that this is possibly a qualitatively material item, and I go and say yes. Okay, other expenses also material. Just want to scroll down to the balance sheet items quickly. Check cash and cash equivalents, for instance. It's telling me there as well, it is not quantitatively material, but I certainly know that cash and cash equivalents is qualitatively material, and I do want to include that in my audit. Scroll further down, and we have loans to and from shareholders. It is material, so it does tell me it's qualitatively material. So wherever either it is qualitatively or quantitatively material, you'll see that it is highlighting the question, is this applicable to the audit? If I say no to revenue, for instance, it's going to highlight in red, and I spoke last week about red cells indicating an error. We can't not audit revenue. It is material. We have to do it. Okay, so on the one hand, where it's yellow, you probably are going to have to say yes, otherwise you're going to need to give some very, very good reasons why you may be not auditing that, but we didn't want to formularize it, and this also comes back to what we're maybe thinking in terms of our review, where some more of these items might be able to be skipped. Okay, I'm also just going to scroll down to my balance sheet quickly and mark the applicable items here. And I just want you to have a look as I type a yes into, for instance here I've typed it into inventory. Two things changed. Firstly, there's a yellow cell that opened up on the right hand side related to estimates, and I'll come back to that, and it also is already giving it a section reference. And this is some pre-population that we did. We did go and try and design some of those sections for you in the background, so that you don't need to go and every time go and allocate the cycles yourself. It is going to pull through pretty automatically, and it's going to align it to a section that's in alignment with where the lead sheet is going to be sitting. Okay, trade and other receivables, I'm just going to go through and mark these other items as yes. And then I get to my loans to and from shareholders. Now with loans to and from shareholders, it could be a debit balance, it could be a credit balance, and it changes, and sometimes it's a mixture of the two. Okay, so I'm going to say here that it is applicable to the audit, and I want you to notice that the section reference doesn't get a number, it just gets highlighted yellow. And the reason for that is because it could be either. This is one of those that we haven't automatically gone and allocated for you in the background. This you need to go through and allocate yourself, and we'll get to that in a moment. So now we've decided which items are applicable to the audit, but I want to ask a question about something like investment income. Now, what do you do when you sit with an instance like this? You've got 16 rands worth of investment income sitting on your income statement. Now, 16 rand is definitely not material quantitatively. Is it qualitatively material? It's a fairly, I don't know, can you call it a grey question related to whether it could be, depending on the nature of the entity. Maybe if you know that the balance should be a lot bigger, you could say, hey, listen, this is qualitatively material, get mixed up with the terminology, and we need to go and actually do something about this. But in a lot of cases, it's like a little bit of interest for maybe those 3 days where your client had a positive balance in the bank account for the year. And we can go and say that it is not qualitatively material or quantitatively material. And as a result, we have the option here now within RAC to go and say, you know what, no, this is not applicable to the audit. What that means is I will not have an audit program which asks me to do anything about investment income. I will not have any procedures. It's not going to feature in my audit anyway, except for one final location at the end of the audit. And we have this completeness of component section, which we'll get to towards the end of the training. And in this working paper, we go and look for these little balances that we maybe said are not applicable to the audit, and we go and just confirm their completeness. If you think about it, if that balance is supposed to be 0, that's the maximum overstatement that you can have for investment income, is that it's 16 rand overstated. That's not material. It's not going to impact my financials. But if that balance should have been 16 million, so it is understated, it can definitely be materially understated. So from a methodology approach, we've said it cannot be materially overstated, but it can be materially understated. And therefore we want to look at completeness, and that's what 70.20 is all about. Having had a recent discussion with somebody who's involved with reviewing files and having a look at the results that URBA come back with in terms of their reviews. Very important tip that I want to give all auditors here. So if you've been fading away or gone to look for a cup of coffee, please listen to this. URBA is of the opinion that if you do skip a line item like the 16 rand investment income, and you say you're not going to audit, they don't mind that you don't audit it. However, what URBA are saying is that this line item, this balance, must then land up on your overs and unders schedule at the end of the day. And this is something I heard literally in this week. So if I've done any RAC training with you in the past, I would not have mentioned this before. And we're certainly going to look at a way to pull that in for you into our summary of identified misstatements so that it will automatically be transferred. But if you are skipping any balances for whatever reason, whether it's in RAC or in other audits, please make sure that any skipped balance, immaterial balance, actually does land up on your overs and unders. Now, in a case like this, the 16 rand, it is actually less than my trivial misstatement threshold. So I would be of the opinion, for that reason, I could skip it because it's a trivial amount. I'm not sure what URBA's interpretation of that would be, but I certainly don't think they could fail you for not putting the 16 rand on there. But maybe 1.6 million, which is not material in the case of this client, but doesn't necessarily need to be audited from a methodology point of view, that I would certainly make sure lands up on my overs and unders I can't say I necessarily agree with it. I just did want to point it out to all of our users to be aware of this, so that if they do this on their audits, that they go and do put it on your overs and unders. So that's a nice quick tip for anybody. If you've got an URBA review coming, maybe there's something to just double check in your files to make sure that you've complied with that. All right, so we've now gone and marked which items are applicable to the audit, and we now need to go and consider estimates. Now, I will deal with it in a lot more detail next week when we look at the document 12.70, which is the ISA 240 considerations. I don't know if you can see that over there. Now, ISA 240 has got some pretty clear guidelines about fraud and management overrider controls, and one of the things that ISA 240 then talks about is actually going and doing procedures on management estimates. We need to go and understand whether management is biased in any way with regards to its estimates in the audit or in the financial statements. So what this document is doing is we've gone and listed only 2 in the income statement, but many more on the balance sheet. We've gone and listed a number of items that are potential estimates within your client. Okay. Now, revenue initial recognition at fair value, I'm going to say yes is an estimate. Determining revenue with reference to stage of completion in the context of this client, I'm going to say no, not too worried about stage of completion. This is a retail store, my little example. Don't know if I've mentioned that before. When we get to the balance sheet, we get to something like my property, plant, and equipment, and you'll see that there are 5 line items listed for you to go and choose from. Depreciation, useful life, residual values, impairment, and fair value. Now, the only one there that I feel you could ever possibly leave out is fair value, and that's if the company or if your client does not do fair value adjustment to their PPE. So depreciation, absolutely, you need to say that this is an estimate. Useful lives, residual values, and impairment are all certainly estimates. Now, I just want to point out something interesting. The fact that management has not impaired their assets does not mean that management has not made an estimate. Remember, the standard requires that you look out for, and this is the accounting standards, you look out for any indicators of impairment. So the fact that management has not impaired means that based on their assessment of the indicators of impairment, there are none, but that's an estimate that there is none. So we do need to go and consider estimates. Fair value, I know a lot of guys are very excited that IFRS SME has now re-allowed fair values. We've already encountered a few support requests where people are asking us to help them with the fair values on their SMEs, but as far as I know, the new SME standards have not actually been finally published yet. All we have is an amendment document. We don't actually have the final standard. So I'd be very wary about implementing it. And also, please be aware, if you implement one portion of the new standard, for instance, the fair value of PPE, please make sure that you're fully aware of all the other amendments. You cannot early adopt only one section of IFRS SME. You have to early adopt the entire standard if you want to adopt it before 1 January, I think it's 2017. So please just be aware of that. Firstly, go and make sure that we actually get an issue date out of IFAC, and secondly, that if you do implement that, you implement everything. I'm going to say no to fair value now, there, and we go and look at something like stock obsolescence for inventory, and we've got doubtful debt provision for trade and other receivables. Fair value, yes or no. Amortized cost, a bit of a tricky one. Is there amortized cost in trade and other receivables? Now also another quick tip maybe in terms of URBA, and if you like, please drop us a mail at support@dataprime.co.za to maybe get some more details. But URBA are also of the opinion that you should be discounting your trade and other receivables at year end. They're from what I've heard, they're getting quite strict about the non-implementation of this discounting. We are still researching stuff from our side, so if we do get more information on that, we'll certainly pass that information through, hopefully within the confines of this training course as well. But URBA are expecting you to be discounting your trade and other receivables. Also your revenue, the split between revenue and interest if you are selling revenue on terms. Now I know that implementation within many clients is just impossible. The other problem is, for instance, if you've got big government contracts, which is the ones that you probably most likely have to discount. Government contracts, they're not going to want to see interest on their detailed general ledger. They're going to want, on their detailed ledger that you send them, their statements, they're going to want to just see the invoice amount. They're not going to care about implementation of IFRS and IFRS SME. And the drawback of that is that you then almost need to run two separate sets of books concurrently to try and get the right value on your income statement at the end of the day. We are just researching and having a look at that, trying to see if we can offer some guidance or ideas or thoughts on that. But URBA are certainly wanting to look at this. And that's the fair value of revenue and the amortized cost of trade and other receivables. So also just something to think about and maybe discuss within your firms about how you're going to tackle and implement this. Okay, cash and cash equivalents at fair value. Now again, I'm going to say that it is an estimate, but if you have no foreign bank accounts or anything like that, you can probably say no to the fair value of cash and cash equivalents. Amortized cost of borrowings, I think, is quite an important one to keep considering, especially if you've got zero interest loans. There's a bit of a sneaky thing there. If you've got zero interest loans, you should also be discounting those. The only time you can't discount them or don't need to discount them if there are no repayment terms. But then I would just go and have a look at the detailed general ledger and make sure that there aren't actually repayment terms, or they're not actually in the background paying off 10 or 15,000 Rand a month, which starts giving you an indication that there is a repayment term, therefore I need to discount. Is management trying to overstate or understate the balance of that loan account on their balance sheet by not telling you what you need to know? Okay, trade and other payables, I'm going to leave it amortized cost, leave accruals, and I'm just marking a few yeses and nos that you can see where this pops at the end of the day. Now I need to go and allocate loans to and from shareholders in my relevant section. And to do that, I'm now going to move over to the second sheet, which is my cycle sheet. Okay. So when I get to my cycle sheet, on the very top, the first thing that you will see here is that it's actually telling me the following components have not yet been allocated to a cycle. And it's telling me that loans to and from shareholders are not allocated. So the nice thing about that is all I got to do is find the cycle that I want to put this into. Scroll down, you'll see, for instance, intangible assets. There's nothing there because we don't have intangible assets, biological assets the same. I'm going to scroll down to my borrowings because borrowings is where I want to go and put my loans to and from shareholders. It's a credit balance and I want to audit it as part of that section. I hit the drop down and all I need to do is scroll through my components. There it is, loans to and from shareholders, and it allocates it. Okay. Now, if you don't like the term borrowings or you don't like the term fixed assets and investment property, if you log in as a manager or a partner, you can actually go and overwrite that cell. You can go and type your own name in there if you wish. And the reason we've made that possible is if I just scroll down to the very bottom, you'll see that there are additional other cycles available for you to go and complete. So if you want to go and design your own cycles, particularly if you're dealing with one of these small or micro clients where maybe you've got a few too many components or it's getting a bit difficult to look at the audit program, you can go and allocate a few to your own cycle that you can go and create for yourself. Give it a name, just use the drop down to select which items you want to include, and then you're going to have your own audit program with your own cycles generated when we generate the audit programs down the line. The other thing I just want to point out on something like cycles, as I've said, we have got pre-populated items. But I just want to show you, under my trade and other payables, cost of sales is automatically allocated to trade and other payables. However, that's not always the best place to go and audit cost of sales. Sometimes, depending on the inventory system used by your client, it's actually more appropriate to go and audit it under inventory. To do that, simply go and select the cost of sales as I have, press delete. In fact, I haven't logged myself in. This can only be done with a login. So let me quickly log in, try that again, press delete, and the cost of sales goes away. You'll see immediately that cost of sales is now visible in the top gray bar. It tells me that cost of sales is not yet allocated. And now I need to go and find my inventory cycle. There's my inventory, and I'm going to use the drop down to go and select cost of sales. Okay. So that is my cycles. This bar, this gray line becomes clear, and then we know that we've allocated all of the cycles that we need to, and we're happy. Now just to quickly go and have a look at the assertions. As I said earlier, we'd have a look at assertions here. Here are the assertions that we're going to deal with in the medium client, and here they are. There's 7 plus authorization. We've just grouped disclosure together as one. And we have completeness, and you'll see that completeness is a class of transaction, an account balance, and a disclosure assertion. And that's what these items on the right-hand side are telling you. It's just telling you what those assertions are. Now, the reason for this sheet, assertions sheet, is you can actually go and rename any of these items as well if you like, but just make sure that you know what you're talking about at the end of the day if you do go and rename any items. You don't want to end up with an inappropriate assertion somewhere. And in the table below, what we do, and this is what ISA 315 asks us, is you can summarize your assertions, but you need to make sure that all of the assertions listed in ISA 315 are linked to an assertion that you have chosen to use, and this little table just shows the split or how it is crossed over. Okay. Right, maybe just one other thing to comment on in terms of the components sheet that we spoke about earlier. I said you could edit the assertions. You can also edit the component name. So if you want to talk about sales instead of revenue, you're able to change that, and that'll carry through the audit program. You are also able to go and put in your own components should you wish, and that can be done in any of these cells. You'll see that they're also highlighted blue, which means that they are roll forward cells. So if you change it this year, it should appear like that next year for you as well to make things easier. And I'm not going to cover it in this training session, but there's also the opportunity to go and link amounts to the formulas in here on the lead sheet. If you do want to start using custom components, please let me know, and I can certainly help you through that process. Okay, so there's a lead sheet, there's an unlinked, that's more of a higher level training session, so we'll release some separate videos to go through that. I don't have time to do that this morning. Stratum is another sheet that appears here, and I'll go through in more detail what Stratum are when we get to the audit programs. And the last sheet in 10.20 is what we call a doc setup, and this allows you to go and add additional estimates. So if you think you need to add more of your own, just come to this sheet and say yes, you want to insert additional estimates. And what happens on this working paper is we basically make sure that there are 5 lines open for every single one of your components. And then you can go and document your own additional estimates that you'd like to put in, if you know the client well enough to go and add those things. And when you're done, just come back to the doc setup sheet, say no again, and any new ones that you've added will now be visible, and it'll then hide any of the excess sheets. Sorry, just maybe Shane, before you come on, I want to show you the what a small client looks like in terms of the cycles. Just want to go to the cycle sheet, and this is the same client. Okay, so this is what your cycles will look like when you're dealing with a small client. as I said, there is your statement of financial position. So all of these items are going to sit on one audit program. Statement of comprehensive income, same thing. All of these items will sit on one audit program once we finally generated the audit programs for you. And then you can go and design your own cycles as well. And that's available at the bottom of that sheet. Okay.